Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, hi, Jim. Lovely Friday here in Vancouver, and the last couple of days in the financial markets have been lovely as well. So here we go.
The U.S. Fed has restarted what they're trying to tell us. Don't call it QE3 or whatever, but it sure smells and looks like quantitative easing.
Well, they came in last month, and suddenly the U.S. money market had no liquidity. So they did some repo where you put money in today, where the Fed puts money in today and takes it back tomorrow kind of thing. But this was just a natural step because earlier in the year you had that condition hit Argentina and Turkey, where all of a sudden their central bank were losing reserves, so their currency went down and their short rates went up. And then, Jim, that's what we used to call lesser exchanges relative to the financial capital in New York. But then when you had trouble, the same trouble in India, which is a huge market and a huge economy, lesser didn't work anymore. So I had to take my old description and call it outlying exchanges. And then in July, the talk about China policymakers lowering their currency, and I was just taking it as, oh, that's policy. And then in early August, I realized, hey, this is the same event where you have the smaller central banks in Argentina and Turkey, then the bigger ones in India got hit. And of course, this is where then China got hit. And of course, our view was that this hit would arrive in New York in the fall sometime. And yes, it did occur when somebody raided the Saudi oil production system, and you had a very sharp jump in crude oil prices and a dislocation to the money market. But I think the dislocation to the money market would have happened anyways, because the Saudi raid was just a kind of a news item. So at any rate, it was classical, the sudden loss of liquidity in the New York money market, which was met in the classical way with injecting liquidity through the repo. And now they're talking about buying treasury bills. So this then gets even more ironical, Jim, because back in March we noticed that the treasury bill rate, the U.S. 3-month bill, which had been rising, peaked in March and actually in April then started heading down, and down quite sharply. Now that's an old indicator that the boom is ending. And the same thing happened in 1929, where the T-bill rate went up until May of that year and then turned down, and in turning down was indicating that that party was effectively over. So there's market forces going on in the short rates, and in a boom, all the speculators get leverage, which increases the demand for short-term funds. and that then increases the interest rates, and including interest rates for Treasury bills. And I think the mechanism is that when that peaks and then starts down, then perhaps the more savvy traders are liquidating, getting out of their aggressive positions and just saying, hey, we've made some money, let's grab it. And then eventually, a little later, then you get that the very safe money, the conservative money, will go to the most liquid items, and that is gold, and it is Treasury bills in the U.S. money markets. So then that's what really sharply drove rates down. So then, of course, the stock market in late July celebrated the first Fed cut by really bidding up stocks, and that, we pointed out, was similar to September of 2007, and the concept of the Fed cutting rates got the last buyers into that bull market. So here we have that the Fed follows Treasury bill rates, and now they're going to be buying Treasury bills, which puts more immediate cash into the markets. So they're reinforcing the downtrend in Treasury bill rates, and the downtrend in Treasury bills is saying that the boom is over. So this is where it gets ironical, because when the Treasury bill rate was rising up till March, many Wall Streeters were professionally worrying, rising interest rates, not good. But they don't understand that so long as that T-bill rate is going up, it says the boom is on. And as we reviewed, when it turns down, it says that the boom is over. So again, wonderful irony from the policymakers who haven't got a clue what's going on. And the bill rate will likely go down to almost zero, as will the administered rate, the federal funds, and of course the Bank of Canada will be following along as well. So, interesting news, but the other good news was that, something was positive with the Chinese trade talks. Something was positive in England with Brexit, so the pound and the London stock market jumped, and this was also positive for the Canadian dollar, which moved up as well. So, the markets got kind of a bit of a hit into last week. Maybe last Thursday, Friday was the worst. And then this week it's been a relief rally, and that's what we're looking at. It's just a bounce within a period of time when some liquidity problems could be discovered.
We'll have more with Bob Hoye right after the break.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with Bob Hoye. Bob, is there trouble in the Indian banking system?
Yeah, they call it a shadow banking. And let's use the U.S. as an example, because you've got the banks that are within the Federal Reserve System that are supposed to be controlled by the Federal Reserve. And then, of course, you've got a whole lot of banks and near banks that are outside of that. And then in every great financial bubble in the past, you'll always have the new young bankers who really know what's going on, and they're going to show the old conservative bankers what they can do. And one in the 1772 bubble in England was the Ayr Bank, AYRE, and it was showing the old bankers, hey, this is how we young guys do business, and then it crashed. And then eventually, when Adam Smith wrote his great book that was published in 1776, and he did include part of his thinking was involved that the failure of the Ayr Bank. So that's nowadays they call them shadow banks, and so it's essentially outside the control of the Federal Reserve System or any of the banking associations. So this is where in any great bull market, you'll always have very aggressive and reckless banking going on. Anyways, but to see now in the last decade the senior central bank, the Federal Reserve System, being absolutely reckless on their part in injecting billions, trillions of dollars into the markets, it's been a form of madness. So the question here now is, you've had the stock market reach exceptionally high valuations, even higher than reached in the dot-com mania in 2000, and a whole lot higher than at the top of the bull market in 2007. And from time to time, you've also had exceptional momentum readings accomplished and also bullish sentiment. So all of this stuff only occurs near the top of a market, and this one has been rolling over, and in which case you have a whole lot of margin debt, and that has to be looked after. And this is where the irony is that the establishment of the Federal Reserve, and actually the senior central bank way before that, was the long-standing notion that a hit in the financial markets precedes a recession. So the theory behind the Fed in the 19-teens was that it would be there as a lender of last resort and would bail out a bad bank and prevent the financial setbacks that then preceded recessions. So the theory has been that the lender of last resort would prevent recessions. And since 1913, this is the 18th. No, we have had 18 recessions, and in that we're now having a financial setback, it's likely preceding a U.S. recession. Probably Europe is in recession already. So they do a dance. Policymakers dance. They do the same thing each time. For example, in 1920, a huge global speculation in commodities blew out, crashed real hard, and then the next number of years, the pricing power of business and industry was very poor, and the Federal Reserve System got concerned about it, so its remedy was to be easy in the credit market, and not understanding that once you've had the big commodity boom, then the speculation switches over to financial assets. So it was in the 1920s worried about not enough inflation and was accommodative, and of course the public was speculating in stocks and bonds, so the extra credit went into there, creating the bubble, and then the crash. And then the long contraction. So here we are again, similar pattern that in 2008 you had a huge speculation in commodities with crude oil up to 147, very hard crash, and then a weak performing economy until recently. And then that then prompted the Fed to say, oh, there's not enough inflation. We got to get it above 2%. And so it was then accommodative, thinking that their credit ease would drive commodities up. But no, that was the old world. And instead it goes into speculation in stocks and bonds. And then now this could be the start. It appeared to us that the speculation reached a classic climax from which you would get roll into a liquidity problem likely in the fall. And yes, we've had the first step on that. We've had a bounce here because of good news on China trade, good news on, they figure in England on Brexit. I don't know what that is about. So anyways, and you had a bounce in crude oil, but I don't think that the problems out there's which is too much margin, too much leverage, and the margin clerks, they have to get the accounts in line. So my guess is that the setback in the financial markets could go a little longer yet.
We'll have more with Bob Hoye right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, another headline that you spotted for us: China's highest risk form of state borrowing enjoys new boom. What is this risky form of borrowing they're up to?
Yeah, that's all I did was grab the headline, but it looks like the locals in China have had some credit refreshment, and they have been, these governments are then relying upon a very, well, they're hot to keep things all together, and have been tapping into very risky credit markets. Because it was said here that China's riskiest form of state borrowing enjoys the new boom. So they're trying to keep things alive through borrowing money, and the credit expansion has been remarkable. And when you start a credit contraction, they kind of get inevitable, and they get going, and there's not much anybody can do about it. But each credit contraction in history, going all the way back to the early 1600s, has prompted some intellectual, and even like there was a financial crash in London in 1618, and then you had unemployment, hardship, and hard times. And an intellectual then, Edward Misselden, wrote a paper and published it in 1622. And his was a brilliant theory. Oh, you could make a credit contraction go away by providing more credit from somewhere, like out of thin air. And then, of course, John Law, who was a radical banker, and going into the South Sea bubble in 1720, said the same thing, and then even the esteemed editor at the Economist in 1873 published that you could prevent a contraction by the central bank providing credit ease at the start by preventing hard times as the financial setback. And of course, the irony on that one is that that Great Depression lasted from the end of the bubble in 1873 to 1895. So the idea of, in a sharp credit contraction, that it can be ended and made better by yet more credit from somewhere else has been around since the early 1600s, and yet you've got economics departments around the world teaching that, generation after generation of economics professors teaching this utter nonsense to generations of eager students. And then some of them get off into central banking and commit the same errors that their counterparts did in any previous bubble. So, Jim, it's going to be fascinating to see how this one works out, and investors should be still cautious. I think that when the next buying opportunity in the stock market comes in, that we will have all the technicals needed for a relatively cautious recommitment to the stock market.
Bob, thank you so much for chatting with us.
Well, there we are, and look forward to next week, Jim.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob or any of our other guests, you can send them to info@howestreet.com. Find us on Twitter @HowStreet, our YouTube channel, Talk Digital Network. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.